Well, the JSE All-Share Index is trading almost 3% higher so far today, tracking positive global markets as investors scaled back fears of a 100 basis point rate hike from the Fed while awaiting the domestic CPI report that's due out later this week. Petri Redelinghuys is trader and founder of Herenya Capital Advisors, joins us now to make sense of how the day is looking so far. Petri, welcome back. The rand, as I was saying, looks to be winning back at least gains today as the safe haven dollar nudged down from multi-year highs. What should we make of this?
Good afternoon. Thank you for having me. I think, to be honest with you, to have any real sort of true insight at this stage is maybe a bit premature. What we're seeing essentially start this week is the second quarter earnings season, if you will, in the US, where big corporates are starting to, report on earnings and sales numbers during the last quarter. So I think, I'm sort of the view, and, obviously I could be wrong, but I'm of the view that unless we see companies growing earnings, if we have a poor earnings season from the US, then I think that risk of recession is squarely back on the table. And we'll see markets continuing on the trajectory that they have been so far this year, which is, further down. What we've been seeing up to this point, I think, is that the markets or risk assets are essentially re-rating based on higher inflation expectations and obviously higher realized inflation, which changes the valuation model a little bit, which brings a lot of the companies that we've seen in the US do so very well, makes them seem somewhat overvalued. If we now see that their earnings has been affected negatively as well, and we see an earnings contraction sort of broadly across most of the companies listed in the US, then I think we'll probably see another re-rating take place and the market take another leg down. So right now, yes, the market is doing fantastically well. The all-share index is up almost 3% on the day so far, as is the top 40 index. The rand strengthening up a little bit. Oil is bouncing, all sort of on this, as you rightly mentioned, this expectation or tapering of expectation for 100 basis point interest rate hike, rather down to 75 basis points. However, everything can change as the week progresses and we see corporate earnings come in. If those corporate earnings are good, then I think we're in for a bit of a relief rally, probably a stronger rand, stronger commodity prices. If the earnings season is bad and corporate earnings are contracting, and we start seeing that forward guidance for potentially, layoffs in the future and that type of thing, then that recession rhetoric is squarely back on the table, and we probably see markets come under quite a bit of pressure. So to make that call, before the U.S. markets open on a Monday morning is a bit tough. I guess we'll have to see how the week progresses. But so far, it seems as though, as you mentioned, some of these fears are being alleviated, and the market is feeling a bit more confident, although perhaps a little prematurely.
So oil prices in Petri also extending gains this Monday, propped up by that weaker dollar and tight supplies. Where's this likely to take us? Because there's just been that meeting last week that we saw President Biden trying to get Middle East countries, the Saudis in particular, to do more in order to bring down the oil price.
Yeah, so, I'm afraid to say that there's not really terribly much the Saudis can do. They can temporarily increase capacity, although they've also said over the weekend that, look, despite what's happening in the political arena, they're not going to make their decisions on oil production based on any sort of short-term political issues that might have reared their, might be the case at the moment. The way that they are currently positioned is that they are at full capacity and they're producing as much as they can. And the issue that we really have with the energy market is that nobody is invested in any dirty energy, coal or oil or anything like that for the last, give or take 7 years. So there is still the structural shortage, situation that's happening in the oil market. And particularly if you look at oil price has come down from about $120 about a month and a half ago to where it is now at 103. Nothing's really changed. If you look at the longer term, oil for delivery in 12 months from now, prices are still very high. It's just the front month, right now delivery oil price that has come down. So that's indicative of the fact that the market is still somewhat constrained. Look at what's happened over the weekend with Sasol. They not just Sasol, Shell is also involved in that, but with, Natprev, is essentially in a situation where they have to call force majeure. They cannot produce petrol simply because there's no crude oil deliveries. So we are in a tight market, and I think that in the short term, yes, oil might come under pressure and has been coming under pressure from this whole inflation rhetoric, but structurally, we're still in a large shortage situation, and we might see oil prices at least remain very strong for the rest of the year.
There's this crash in cryptocurrencies that in the US, it's now taken two new South African company victims, that's Invicta as well as New World Holdings. Is there no bottom at all for this alternative currency crash?
I have this theory that's kind of based on the 4-year halving cycle of Bitcoin mining. Right? So every 4 years, well, it's maybe a bit too long-winded of an explanation to go into, in the time that we have available. But essentially, it boils down to there's a 4-year cycle that particularly Bitcoin has been adhering to, with the peak of that cycle, the 4th year having been last year. And then in the first year of the new cycle, we see an 80 to 85% correction in price. And if we go back and we look over the last couple of cycles, it's done exactly that. So my view is that we probably see a similar thing, which would mean more downside for cryptocurrencies, albeit a very volatile time. But we probably see Bitcoin sort of trading down to around $8,000 in the course of the next 6 to 12 months. If that is the case, I'm assuming there probably will be a few more casualties in the crypto space. But this is the nature of the beast. It's been doing this. If it completes this cycle, it'll be the 4th time that it's done it. So it has a little bit of, I guess, track record behind it. It is a new wild asset class that's technically not an asset or a currency or, anything at this point. Nobody's really classified it or regulated it as yet. So it's the Wild West for now. I guess we'll see what happens. I think if we can just put a message out to the average investor out there, don't put money into cryptocurrencies that you cannot absolutely afford to lose. It's not the silver bullet that's going to make all your financial problems go away. Yes, people have made phenomenal amounts of money from owning cryptocurrencies, but they've been very early adopters in the most part, and I can assure you that they didn't buy when prices were peaking or coming down. So if you were looking to buy, maybe be a bit patient for another couple of months and see if we get lower prices.
I'll talk to you about share prices around H&M because there's been an announcement in the last few hours of H&M winding down business in Russia, not entirely unexpected when you look at global trends since the Russians invaded Ukraine at the end of February. But what's going to happen now for H&M specifically with this decision?
I'll be honest with you, H&M is not really one of the companies that I track very closely. But I don't know. To be honest with you, I think these companies that are pulling out of Russia are somewhat short-sighted. We saw when McDonald's pulled out, it took them about a week to rebrand the store, and then they sold 120,000 hamburgers in a single day, right? So I think that companies can sometimes be somewhat short-sighted with this type of stuff. There's more the West tries to sanction Russia, the harder it works out for the West, unfortunately. So I guess we'll see. The market might cheer them on. Market trades in a couple of things. It's forward-looking in terms of what it expects in the future, but it also is very sentiment-driven. So if they get if there's some positive sentiment around that, the market might reward them. However, they lose sales, they lose revenue, but they also lose that expense base. So to be honest with you, I'm not really too sure how it works out for them in the long run. It depends, I guess, on how long the Ukrainian conflict draws out. Another 6 months, another 12 months, it might have a severe impact on companies' earnings that have pulled out from that market.
Petri Redelinghuys, always good to speak to you. Thank you.